everybody for joining us. This is one of our most popular webinars that we've, I think, ever held, and we're so excited to have you here. This is a sneak peek in the lead up to our Impact Investing in Africa course, which is a course that we run every year. And I'm a little bit biased here, but it gets more and more fun every year that we run it. And our set of alumni gets bigger and bigger. We now have over 300 really amazing and powerful impact investors who have gone through the course. Not all of them were impact investors when they went in. Many have shifted careers or have shifted their organizations towards impact. And I get a lot of questions about how to get involved in impact investing and how to shift my career. And this is it. This is why we created this course. So if you're in that position where you're asking that, highly recommend checking out the course. We've got an amazing lineup of speakers. We really enjoy engaging with them every year, and we make sure that it is very much an engaging experience. They are not talking to you, you are talking with them and with each other. So the speakers are amazing. The networking opportunities with one another is fantastic, and we are very intentional about taking that beyond the course. So we have a group of alumni that meet on a regular basis now virtually, and share opportunities, ask for advice, share knowledge. It's a fantastic group of people to be a part of. And obviously the actual content on the course teaches you everything that you need to know about impact investing in Africa. And if it doesn't, you can ask us and we will find a way to get it in there. So please do have a look at, we'll be sending a follow-up email with all of the information you need to know about the course. Feel free to share it far and wide. And as we lead up to that, enjoy this amazing lineup of women that we have today.
So I am the co-founder of Proof of Impact. I'm also the person who dragged Oni to Africa. I'll claim that and let her stay. It's a big topic, data and impact. And I always hate this when it doesn't click. So here we go. What is really stopping the growth of impact investing, which is, I think, one of the topics of today. So we have the impact investing universe we want to talk about, investing in women and girls, the data, right? And then how do we create investment structures that align the data with what the universe wants? And when I said that we started in impact investing in 2008, it wasn't called impact investing then. It was referred to as social entrepreneurship. It was referred to as some form of concessionary investing, doing good, doing well. And over time, it evolved to impact investing as a category. And the category, according to the GIN, as you all know, has about $715 billion of assets under management, which sounds like a lot of money, but it's peanuts, considering that there's about $300 trillion in the world in wealth. And we've done some research under an entity called 17 Africa, where we looked at, of the 300 trillion, how much of that is actually looking for financial return and some form of positive contribution, which is what impact investing is about. And it's roughly 100 trillion. So having siloed 715 billion to being a designated category has been a mistake. And it's also been a mistake because within that category, the complaints are that 92% of impact investors can't get the data to really show that their investments are truly impactful. 73% are struggling with, okay, I've got this data now, but what does it mean, right? How does it relate to impact outcomes, or how does it relate to financial performance? Then once I want to make investment decisions based on impact, how do I compare different assets? And most importantly, the cost of getting impact data in any form of usable information is extraordinarily expensive. We're talking about $1.7 billion per year on the current $715 billion, which is way more than most fund managers can afford. So this is looking at the silo category, but there's a new opportunity now. So if we don't think about the 715 billion, but we think about the 300 trillion, right? How do we move that money to make a difference? And there's actually an incredible opportunity, not just to show contribution, but to show reduction in risk. And I'm a member of YPO, and it was like a month ago, they did this article, you know, about women in the African technology sector. And I had previously a fintech business in Africa, which was very much not impactful from a social environmental perspective. It was financially very successful. So I got included in this. And they were asking, you know, can we say that investing in Africa in women is financially more sound than not? And the honest truth is, I don't know, because we don't have the data. The hypothesis is that if you invest in women around the world, and Harvard has done a lot of studies on this, you will have greater societal and environmental impact because they manage and often measure these aspects more than companies run by men. Because of that, you have lower financial risk because you have no what's called hidden risks in the assets, which should reduce what all investors base their decisions on when they make an investment allocation. In a reduced risk means that the risk adjusted return has actually gone up. So risk and return are at one level, you reduce the risk, then relatively the return for that amount of risk has gone up. But again, we need to get to data points who can really show that this hypothesis works. And that's what's really our focus at Proof of Impact. So very briefly, when we talk about impact data, currently 99% of all of the impact measurement reporting that's done is done by human beings, and it's done on what we call self-reported information. So either human being sits down with the management team, or a human being, an individual in companies filling in a B Corp survey or something like that. What the new opportunity again is, thanks to the vast amount of technology that is available everywhere, particularly in Africa right now, is that we have new sources of data that are far more objective, far more reliable, and most importantly, they can offer granular information in real time. So the right-hand side of this diagram is profit data, which is what we currently see in the companies. It's their operating systems, it's how many people they employ. If you're lucky, you get this aggregated gender information, but a lot of the times you don't. You get some information maybe on kilowattage that their solar panels produce. So that's their own information. And then the easiest instance that is still self-reported, slightly better is if we can integrate directly with the the ERP or the CRM solution. And that gives you, what we traditionally look at, right? The overall company data. But the opportunity lies now in planet data. Over 70%, for example, of agricultural information doesn't come from human beings and consultants. It comes from sensors, devices, drones, satellites, temperature gauges, CO2 measures, huge new sorts of information that we can then check. Hey, a company just said that they had their solar panels working X amount of hours. The data in terms of the weather map and the solar panel chip card is showing that that's impossible. So then you already have an alarm system going off. And then the third level of information, which is the richest from an impact perspective, is people data. So because everyone around the continent has one of these, we can get insights from employees, from people who use services that we never had before. And that together, if you collect the data, you can then verify this data, because you can only make investment decisions based on verified data. You cannot make investment decisions based on purely self-reported data. So there's a couple of use cases. This is an Africa Clean Energy company which supplies sustainable cook stoves to women across the continent. And again, there's a huge problem with investment allocation for even energy transition. Billions get spent on the continent on building solar, installations for commercial and rural use. However, 80% of electricity that is required is for cooking and for heating. And if you look at how much was spent, it's not even $10 million over the last year to distribute efficient, clean cook stoves to the African continent. So again, we're trying to show the data, and with that data, we're now making this asset visible for, in this case, a UBS, because it's going to go into the UBS Impact Investment Platform, where high net worth individuals can actually see the difference they can make by investing in this company versus one of your average solar installation companies. Similarly, this is actually an India example, but it's a company that supplies banana leaf baskets to IKEA. Huge amounts of impact because of thousands of women they employ. But again, we want to show the reduction in risk of this asset if you fund it, because they track their labor data, like minimum wages paid, how many women they employ, the working standards, but also their environmental data, how much waste they have, how much carbon they produce on a live basis, digitally. So it makes their funding costs go from 20% per year to borrow $5 million to pay for raw materials and labor to 10% per year. So it's, again, it's an example of unlocking financial prosperity through impact data. And then, yeah, last week, I mean, this is not my favorite group at all, but it's just really quite cunning that a BlackRock comes out that they are committing, or that they've actually borrowed $4.4 billion from other banks in the US predominantly, but they need to hit certain staff diversity targets in order to keep their cost of funding down. So again, this is just to show what we're doing isn't isolated to $715 billion. It is now what we need to do for the $300 trillion. And that's really the opportunity, which is to make Africa and women visible so we get access to that amount of money.
And next up, we have Shaluba, who's going to be discussing gender lens investing. Shaluba is a gender lens investor herself, and she is currently raising a fund that is an agricultural value chain impact fund. She's also the Secretariat co-lead for the National Task Force on Impact Investing via the Bertha Center. So Shaluba, over to you.
I am the Secretariat co-lead for the National Task Force for Impact Investing, but we're also currently establishing an agriculture value chain fund that predominantly looks at empowering women. And this is key for us, given that we are a female-owned and managed fund management group. To start, I'd like to articulate the business case for investing in women. I think, firstly, gender equality is integral to Africa's economic and social development. Gender equality is goal 5 of the SDGs and a key enabler for the achievement of other development outcomes. What we know is there are significant limitations women face accessing finance globally and specifically on the African continent, and there are inherent biases in financial systems. There's also lower labor market participation, and further, women are underrepresented among investment decision makers and fund managers. And therefore, not only is there a clear social need to close the gender gap, but there's a strong business case to do so. The evidence and the stats show that investing in women is a multi-trillion-dollar opportunity, and closing the gender labor and financing gap could add up to $28 trillion to annual global GDP in 2025. Investing in women also pays dividend in other areas, given that women spend 90% of their income on their households, which goes directly towards food, healthcare, education, and other such amenities. Numerous research also supports and shows that there's a strong correlation between gender balanced leadership and financial performance. So I think what's clear is there's definitely a strong case for investing in women on the continent. So if we then go into gender lens investing, gender smart investors recognize that financial systems engage and benefit men and women differently, and these investors are actively committed to considering gender in the investment process and to using finance as a tool to promote gender equality. Gender lens investing is therefore the process by which gender smart investors intentionally and measurably address gender disparities and examine gender dynamics to inform their investment decisions. We've listed a number of examples on the continent, which are quite exciting and speak to some of the activity that is taking place. I think firstly, we've got the African Development Bank, which has partnered with the Canadian government that recently launched a gender-focused climate finance fund, which is providing concessionary capital and loans to climate change related projects with a strong gender responsive component. We also have the Alethea IDF fund, which is a $100 million fund to build the investment gap between men and women and is investing in 6 countries on the continent. Thirdly, which is worth noting, is the Africa Trust, which is an early stage gender lens investor committed to investing in women entrepreneurs. And I think maybe lastly to touch on is the Graça Machel Trust, which also has a gender lens Pan-Africa investment vehicle. If we then move to the final slide, I'd like to close off with the future and the anticipated growth of gender lens investing on the continent and highlight 7 trends we're likely to see. Firstly, we're likely to see more women ownership, women in management and leadership at an employee, supplier, customer, but also at a stakeholder level. Secondly, we're likely to see growth which will occur when efforts and strategies are more gender proactive and inclusive. Thirdly, we're likely to see the rise in investment goals and targets related to gender diversity. Fourth, I think, which is quite key, is enhancing the capacity of women fund managers on the continent. And there are numerous efforts that are taking place to develop female fund managers on the continent, which is quite exciting. Fifth, I anticipate there will be more investments into women-led businesses. And then I think we'll also see the prominence of more products like gender bonds and data that supports the case for investing in women. And then lastly, I think what is key and needed is to institutionalize gender smart investing by adding diversity criteria, fostering gender inclusive policies, creating gender smart solutions and toolkits, but also learning from international working groups such as the GINS Gender Lens Investing Working Group.
Moving on, so we've spoken about the future of impact measurement. We've spoken about the future of impact themes and how we integrate women into that future. Next, we're going to be talking about, the next 2 speakers, a really, really interesting discussion around the future of financial instruments when it comes to impact investing. And so I'd like to introduce Lise, and Lise is a repeat speaker on our course. It's always wonderful to have her, so we keep inviting her back. Lise is the Deputy Country Director of the TREC program, which is an initiative of the Jacobs Foundation and one of the leading experts when it comes to mezzanine finance on the continent.
At the foundation, we are very intentional about how we carry impact investment. And during the 3 years that we've been investing in Côte d'Ivoire with the objective of helping the country emerge as a hub for affordable market-based solutions in education, it has been critical for us to partner with local entities and to adapt our instruments to both our own need for performance, but also to the circumstances. And if you go to the next slide, basically the question today is, what does the future hold for impact investing in Africa in terms of investments, in terms of instruments that are being used? And my answer would be that the future holds a more tailored approach to investing in general. It has become very important to not use blanket instruments if we want to successfully invest for impact. Let me illustrate why through the use of real case studies, but that I have anonymized because of confidentiality. I would like to first talk to you about ABC Fund's investment in Sarah, a hardworking entrepreneur based in Burkina Faso. ABC's investment team is like all of us here, wanting to change the world and to give life-changing opportunities to amazing and impactful entrepreneurs while earning a return for their fund. They met Sarah, who had a clever, impactful idea in the agribusiness space and a proof of concept. They then decided to invest $300,000 US in pure equity for 45% of the company. In only a few years, her business expanded across the continent, making a 5-digit figure in USD terms. And then when the time came for ABC Fund to seek an exit pathway, it was really hard despite the rapid growth and the good financial performance of the company, because finding a secondary buyer in that market was just really challenging. On her side, Sarah was also eager to regain full ownership of the company, but it was really difficult for her to basically gather the money, or just thinking about the price to pay to get back that equity would have been too complicated and would have hurt her runway. After a few years, pressure from donors of the ABC fund to exit both the company and the market has forced the fund to simply write off its investment, leaving on the table a beautiful opportunity to tell a successful investment story in one of the markets that needs it most. In the second case study, the second slide, I would like to talk to you about the story of an investment in Nathalie in Côte d'Ivoire. Nathalie is an entrepreneur in the education space, and she has been heading a low-cost private school for about 10 years. Doing well, but stagnating given the lack of available capital and also the lack of support to get her company to that next level. ABC Fund was interested in investing in her initiative as well. However, Nathalie was not too comfortable with equity. It was important for her to retain as much ownership as she could of her company. Therefore, ABC Fund and Nathalie explored different instruments, negotiated, and eventually settled on a hybrid solution. So the fund was able to get 5% equity stakes while providing Nathalie with a bigger loan that would have two components. First, a fixed interest rate that would ensure a minimum level of revenue for the fund, and then a variable rate structured as revenue share. And that will allow ABC to basically benefit further from the envisioned growth of the company. In Côte d'Ivoire, the ABC Fund, I'll stay on that side a little bit longer. In Côte d'Ivoire, the ABC Fund was able to nurture relationships with financial institutions that followed with interest how Nathalie was managing her company, which basically started as being a school and ended up being a chain of schools. Then it was not a surprise that when eventually Nathalie asked one of the major banks in the country for a loan that would both pay back the loan that she owed to ABC Fund, and also a bit more money to further accelerate her expansions outside the country, that they said yes. With the increased revenue of her business, she was also able to buy back the small share percentage of equity that ABC had at the pre-agreed multiple that was in the shareholder agreement. Her experience with ABC helped her better structure her business. It helped her build new skills. She received support throughout the hiring of key staff and with the elaboration of her expansion plan. She was also able to build a robust credit history that allowed eventually a mainstream financial institution to give her that loan. So as you see in the case for Nathalie, the instrument was adapted, allowing to both respect her wishes and to provide an attractive return to the investor. So the impact on the company was undeniable, and the investment strengthened the ecosystem as well. The ABC Fund investment team were quite proud of their achievement and became eager to share more broadly with their peers. Being flexible with investment instruments and adapt to local realities is critical if we want to fulfill the promise of impact investing. As we all recall, the reason why impact investing was adopted by so many organizations is because there's not enough money available in the philanthropy space to reach the Sustainable Development Goals. And there is a necessity, as mentioned by Fleur earlier, to tap into the trillions of dollars that exist into the private sector. And to achieve this, it is our collective responsibility to create a solid business case with impact investing. This means that all of us here have a duty to structure our investments in a way where we have to do good and do well at the same time. Therefore, I invite you today to stay creative within the limits of the law, of course, and use mezzanine finance when needed in Africa so that we can have more successful exit stories.
So Julia, I'm going to invite you to speak a bit more about alternative structures, particularly revenue-based financing.
My name is Julia Price. I am the co-founder of Linear Capital. We've recently secured a USAID grant package, including a first loss piece, to pilot revenue-based financing exclusively as an exclusive mandate here in Southern Africa. And so really just a very opportune time to talk to you about what we're doing and how we see the opportunity in Africa. Thanks, Orny. First slide. So I wanted to start off with this very, very simple slide because when I historically thought about impact investing, my mind would always go to the investee, the target investment, where the beneficiary sat, and really where the data and the true meatiness of the impact was going to be achieved, both commercially and on an impact basis. But through many discussions over many years with people in the impact field, and particularly through the course that Orny runs at UCT, which, by the way, if If you haven't attended it, I would highly recommend it. I realized that actually to have impact at scale, we need to do two things. The one is to take capital where it isn't naturally going already. And by that, I mean taking capital into debt and equity opportunities, mezzanine opportunities that wouldn't naturally attract traditional funders. But secondly, and equally importantly, we need to channel that capital in smart ways to those investees using different instruments. And I love that Lisa's just talked about that. But we need to walk on paths that are not already worn to allocate capital into those investees. And so the instruments we use are as important as the investees themselves. And the tools that we use are as important as the targets themselves. And so I wanted to start off by talking a little bit about blended finance. And for many of you, you will be familiar with blended finance and how it works. But essentially, blended finance is the use of catalytic capital, typically from public or philanthropic funders, to attract commercial investment into impact opportunities. This is one of those channels, this is one of those routes that hasn't yet been worn, but we need to go down these avenues more and more to be able to allocate and deploy capital smartly from those with different risk profiles into impact and commercially viable investments and opportunities. So the blending really occurs at the capital stack level for projects or companies where the real or perceived risk is very high relative to the promise of returns. Public or philanthropic capital or development capital, usually at below market returns, is placed into the blended finance structure and mobilizes private capital at market returns. And so importantly, we are able to see multiple organizations sitting alongside each other, investing into an opportunity that they wouldn't otherwise have come across or been able to invest into, and to achieve the returns that each of their stakeholder groups require, both from an impact and commercial perspective. And really the three legs on the blended finance stool are catalyzing and leveraging capital. That's really important. $1 of donor finance doesn't result in $1 of impact. It should result in $10 of impact. But because of the perceived risk and or early stage nature of the project or the business, we're not able to attract that additional $9 of capital into the project. The second leg of the stool is to enhance the risk-adjusted returns to a point where the project becomes attractive to funders. And the third is obviously to deliver high impact and to measure that impact well. Now, these structures can take many different forms. You can find first loss, like USAID has provided for us, that supports traditional equity and debt, senior debt funders. You can find it in the form of flexible debt instruments with different structured exit mechanisms that again just provide a junior debt level. You can find it in the form of guarantees. We've seen recently the EcoBank, IFC and EIB collaboration to provide finance to SMEs. And that really is through guarantees of interest being repaid. And we can see it through technical assistance, which helps investees within a portfolio perform and deliver the returns required for that fund or model to perform. Thanks, Orny. Next slide. So let's talk a little bit about the stats for blended finance. We see about 45 to 50 transactions per annum at around about $11 billion every year. Over a third of that is in sub-Saharan Africa and majority in Kenya, particularly because of the innovation that we're seeing in the fund management space there in Kenya. Over 50% of blended finance structures are for energy deals. 60 to 70% include some form of concessional capital, and around a third of them include a guarantee or first loss. Over 50% of transactions include some form of debt, which is natural given the idea of first loss or concessional junior debt, a third into equity, and only 10% into mezz. So there's real opportunity here to structure new instruments to bolster that mezz component. And interestingly, the beneficiaries, we'd imagine over 50% are low income, bottom of the pyramid beneficiaries, but only 14% are women and only 4% of youth. So there's a real opportunity there for blended structures to target those types of beneficiaries. We know about the benefits of blended finance. We talked about the shifting of risk-adjusted returns, the collaboration of organizations to achieve each of their goals simultaneously, to build track record for new models, and to share market knowledge and build local capacity. But why is this not happening already? Well, we have limited awareness and data. And to Fleur's point, we really need to bolster our data. We've got institutional mandate constraints, and we've got technical expertise that's required. Okay, Orni is nudging me along, so let's go into the next slide. Okay, and into the next slide. So revenue-based finance is one of the tools that we can use in that flexible portion of blended finance. And it really is the provision of capital upfront for a percentage of revenue going forward. And why do we need this as an instrument? Well, because for impact entrepreneurs, projects that are early stage tend to have low risk-adjusted returns. Debt is largely unavailable or very expensive, and equity capital is highly dilutive, and as we just saw in the last presentation, very difficult to win back at later capital stages. For the investors, mandates can be constrained, equity capital is tied up for long periods of time, risk management is difficult without follow-on capital, and there are large portfolio failure rates on an equity and VC mandate. So there's real structural need for us to find other instruments like revenue-based finance. Thanks, Orni. Next slide. So revenue-based finance and other similar instruments can fill the risk-return frontier. And so when you're looking at impact investments, very few of them are able to get bank debt or high-yield or convertible prefs. Many of them can get grant funding, but the problem with grant funding is that it has no velocity of capital. It goes into an investment and it doesn't ever get returned. And the beauty of a revenue-based instrument is that it does increase the velocity of capital. We can see with impact investments that are highly commercial, we can see that they do start to return some cash flow that can be recycled into new investments. Thanks, Orni. Okay, so we know the benefits of revenue-based financing is really it keeps equity in the hands of founders, particularly women and previously disadvantaged founders. Equity holds the keys to drive revenue and create jobs, and share schemes can then be put in place to empower staff. For investors, it creates liquidity, and it creates an opportunity for follow-on capital and risk management. And again, that velocity of capital is really helpful when looking at an impact portfolio. I've listed a number of the organizations globally that are doing revenue-based financing already, and I look forward to keeping you posted as we continue to pilot and scale revenue-based finance for impact in Africa.
Joined us. Thanks for joining us. And if you want to be a speaker on our next webinar, it's a very quick process. All you have to do is join our course. Two of our speakers today were previously on our course, so our next webinar could feature you. Thanks, everybody. Great to have you.